And thank you for your presentations. I suppose at the outset, has anything been learned? Has anything changed? Because this kind of paints a really bad picture of where things are at. And I suppose what I'm concerned about is we have the banks in here time and time again. We have the central bank in here. Why do you think the central bank aren't addressing these matters? Because basically what you're saying is that there's liquidity problems, losses are being hidden, and we're not being given the true picture. So you have the different layers, then you have obviously the standards body, but you have the central bank, who's the regulator. But you also have the audit companies, the big four, and we have asked for here, in similar to Britain, for those audit companies to be examined and to come before the competition authority. And that's certainly something that I feel very strongly about. So it's almost like there's a collusion there. Can you just speak to that in terms of what has changed?
Thank you. It's a very good question, because what struck me early on when we identified the problem back in 2009, 2010, was that one of the first people to openly speak out and not only describe the problem, but describe it very clearly, was Central Bank Governor Patrick Honohan. He put it beautifully. He put it so clearly. The Bank of England wasn't saying the same thing. The French banks were the French central bank was kind of saying the thing because it was in a position where it could. Mervyn King, when he was then the outgoing governor of the Bank of England, started talking about it. But I think the problem the central banks have, in law, it's illegal for them to prop up a bank that is insolvent, because they either lend to a solvent bank or they have to transparently put in new capital. But if they're lending money to a insolvent bank, they are effectively putting in capital into an insolvent bank, and by that they shouldn't then be able to whip it out again. So the conflicts of interest that arise when a bank that is essentially bust goes into this limbo state where a central bank lends to it creates huge conflicts of interest. It's why, in my opinion, it's best to let a bank fail, because you don't have this sort of ongoing zombie state, living dead, where the central bank is conflicted because it's lent money to it, the auditors are conflicted because they've followed particular accounting standards that haven't delivered company law, the directors are conflicted because they've run a bank badly and then they've given numbers which don't show the true position. So the conflicts of interest are absolutely enormous. And interestingly, Cormac refers to the case which settled in the High Court in London in February of this year, called AssetCo. The case is AssetCo. It was a case against Grant Thornton for a company that sold buses to the United Arab Emirates. What's particularly interesting about the AssetCo case, it's the first major case against an auditor to settle in a UK court since 1968. The reason is the law is so clear that the 68 case is enough to refer to, and the respondents, i.e. the big four firms, prefer to settle out of court rather than having the 68 case sort of given a second lease of life. What happened in the AssetCo case, they decided to take it right to the High Court, so the case was decided in the High Court, and the AssetCo case describes exactly the not only 1968 position, but 1890s law, because these are the same things around then. And the law is quite shocking. It's quite clear that in the AssetCo case, the auditors owed back to the company all the dividends that had been paid off of false numbers. Not only that, they owed all the funds that had been put into the company and were then misinvested. So it's effectively the consequences of making business decisions based on the wrong numbers. It's called consequential loss. And most people, when they see the case, are actually quite shocked that that is the legal basis of settling on cases where the accounts were faulty. In fact, the position is so harsh, you can see why people don't want to sort of go around the street with a loud hailer telling everybody that's what their liability position is, because potentially any company where there has been misinvestment due to the numbers being wrong could follow the AssetCo case.
Yeah, because you refer to Carillion here as well, and like the impact of the audit company that ruled that Carillion was in a good state of health, and then we saw it was the small and medium businesses here who have really suffered as a result of that, and there has been no
corrective action.
No correct action whatsoever, and that's why at the time I had asked for us to have the audit companies, to have the competition authority examine the audit companies here.
Do you get the audit companies here? One question you should ask them is, as a result of this AssetCo case versus Grant Thornton, is it time for banks to restate their accounts? Because if they did restate their accounts, they would have to reveal all losses. And I think what would come to light is that between 2005 and 2008, Irish banks were moving into insolvency. There was a reckless period, and they were giving out loans to everyone left, right and centre. So they were accumulating huge amounts of losses, but were not disclosing it. Now, the central bank were aware that the banks were doing this, but the Irish government, officially at least, was not aware.
Are you sure that the central bank were aware?
We have documents going back to 2001. They were aware of the problems with IAS 39. They raised concerns about it, but they were certainly aware of it. So between 2005 and 2008, we had a situation where the European Central Bank would have been aware that banks were measuring solvency and measuring their losses incorrectly, but the Irish government was not so aware. In 2008, the Irish government effectively either gave a guarantee or injected funds into the bank, but the banks had suffered losses at that point. And this has caused a problem which is probably explaining why people are slow to correct this issue. The problem is that once you lend money to an insolvent bank, you cannot take that money back out again. The bank must declare that it's insolvent, and then the money is distributed to all the creditors evenly, so that no creditor is affected worse than other creditors. What happened in 2008 is that many of the banks, if not all of them, were insolvent, and the ECB had injected funds at that point. So if you think about it, the ECB made a loss at that point. Now, what should have happened is the banks should have declared their insolvency, and they should have looked for an equity injection. And the central banks should really have said, we don't want these commercial banks to fail, therefore we need to put in an equity injection. But they did it the wrong way around. They lent money to the banks. The banks delayed telling us about their insolvent situation, so the ECB lent money to the bank. Then the banks approached the Irish government for support and funds, and then the Irish banks admitted that they were in difficulty. It's the wrong way to do it.
Can I just bring you forward, how can we identify now which banks are solvent and which banks are not solvent?
Well, one rule of thumb method is to look at the assets which were sold to the National Asset Management Agency. Banks would not have suffered a 30, 40, or 50 or 60% discount if they could have held on to the loans and serviced them themselves. And if a bank has assets on its balance sheet where they're overvalued by 30, 40 or 50%, you can rest assured that that bank is insolvent. There are other tests. For instance, there was an issue surrounding burning the bondholders, and some of the Irish banks took hedge funds, American hedge funds, to court. They said to the hedge funds, we have huge losses here, you should bear the burden of some of these losses. And the hedge funds more or less said to the banks, well, as soon as you declare yourself insolvent, we'll start admitting to the losses or accepting the losses. But of course the banks were unwilling to state that they were insolvent, but the fact that they attempted to burn the bondholders meant they felt that the bondholders had suffered losses. And if the bondholder suffers losses in a bank, it means that the bank is insolvent, because it means that the assets are below the value of the liabilities.
Okay, but so are you saying that some or all of the Irish banks are insolvent at this moment in time? No, we have profits declared all the time. We have dividends being given out now. We had Ulster Bank in here before us a couple of weeks ago. Mm-hmm. I think they have given 1.5 billion or something to RBS.
Are the banks insolvent at the moment? The question you have to ask them is, are they valuing loans at their recoverable amount? And they won't be able to answer yes to that question, because under the IAS 39 accounting standard and under its replacement accounting standard, banks are not required to value loans at recoverable amount. They're allowed to use historical values. So if I lend you 1 million and you can only afford to repay 400,000, according to the current accounting rules, I show the loan at 1 million, not 400,000. Now, that is against the law because the AssetCo Grant Thornton case says, no, you must identify how much you have genuinely lost before you can start paying a dividend. So the question you have to ask the various banks when they come in is, can they give you an assurance that all loans are never valued at above what the banks expect to recover? If they give you that assurance, and it's genuine, then they're not solvent. Sorry, they're solvent. But if they don't give you that assurance, then they're not measuring their solvency correctly, and therefore there could, like 2008, there could be a huge mountain of hidden losses.
So, what specific legislation do we need to put in place to address this?
Ironically, the legislation is already there. It's just a question of whether the banks are complying with it. The only thing I can direct you to is the AssetCo case that Tim has referred to. There is also a UK report that came out in February called The Future of Audit, and they made it clear in that report that the advice given by some accounting professionals is incorrect, and yes, those accounting professionals said it's incorrect as well. So the legislation is already there. It's just a matter of getting the banks to comply with it.
So do you believe we need to do a similar report here as similar to the future of audit?
Well, do you want to
comment? Yes, definitely. Because what was particularly interesting about the Select Committee of the UK Parliament that was looking at this area, they took evidence from the accounting firms on the Wednesday of that week, where they were given the view of the law by the accountants. On the Thursday after, the AssetCo case settled, and by the time the committee came back on the Tuesday, they realised that there was the court's version of the law and what they'd been told the day before by the accountants. And interestingly, on the Tuesday, the French firm Mazars appeared before them, and Mazars had no inclination, they're a very professional firm, they just told the truth. So basically the whole truth and nothing but the truth came out in that session. It was quite good to watch. Clearly, for historical reasons and due to EU directives, UK and Irish law, company law, is identical. People who are chartered accountants of the Irish Institute take exams based on the same questions, just with one paper has the UK Act reference, one has the Ireland Companies Act reference. And from talking to Cormac and looking at the two acts over the years, what's quite interesting is if somebody tries to pull the wool over your eyes, and to me they try to read the UK Companies Act to me wrongly by misinterpreting words, whoever drafted the Irish legislation has made it clearer. So it's actually easier to understand the British Companies Act by actually reading the Irish legislation, because somewhere along the line the draftsmen were better who drafted the Irish legislation, and it's impossible to make the same mistakes that the people who misinterpreted the English Act have done, because the Irish Act is so clearly set out, and all it needs, as Cormac says, is following the law.
They won't be able to use as a defence that English law is different to Ireland on this. So if you were to examine that report, The Future of Audit, and present the findings to the bankers, they wouldn't be able to challenge it on the grounds that that's British law and it doesn't apply here. It does apply here.
Yeah, have a look at that. And just in terms of the ECB role in it, obviously the ECB have a scrutiny role in the Irish banks and the central bank here. So are they missing all this?
Will I start?
Why are they ignoring this?
The ECB appear to be not interested in this, and that's understandable because it would open up a can of worms. If you think about it, when the ECB lent money to an insolvent bank, let's say Anglo, they're not allowed to get that money back. So therefore they're not over-enthusiastic about measuring what's known as prudence, in other words, measuring loan losses correctly. They should be, but they're not. We've put it to them, but the replies are, they take 6 months to reply. When they do, you see things like constructive ambiguity and confidentiality, so they're not interested in looking at it. But this is of extreme importance to Ireland, because when you lent money to the banks in 2008, those banks were potentially insolvent, but you were led to believe that they were solvent. So therefore the Irish government doesn't have a liability in respect of those promissory notes or in respect of that guarantee. And therefore, because you're paying back the money, 3 billion a year or whatever it is, I think there is a question on the legality of whether you can pay that money back on the grounds that there was never a liability to begin with. The story would be very, very different if the Irish government knew that the banks were insolvent in 2008. Then, when they put the money in, they would have known that they were putting it into an insolvent bank. But it's I'll give you an example.
So you're saying that the government didn't know?
The government in 2008 are on record as stating that they assumed that all banks were solvent and that this would be the cheapest bailout.
Do you believe that?
I would have believed it in 2008 because it wasn't well known that banks were insolvent. It was only in 2010 when it started coming to light. And in 2010...
But was there not a close relationship with the key people in the banking system here in government at the time? It's documented in terms of...
It could be that there was a close relationship and that they knew, but then you would have to suggest that they were telling a lie when they said that the banks were solvent. I don't think you'll be able to prove that they knew. I might be wrong on that, but I don't think you will be able to prove it. What is certain is in the bank inquiry, one central banker gave evidence that he assumed that all banks were solvent in 2008, and he based, I think it was John Hurley, he based his knowledge on a PwC report which stated that all banks had sufficient capital to withstand future losses. Now, it could be that some of them said, we know this is completely false and lies, but we're going to put it out anyway. But I don't think you'll be able to come up with evidence on that. In 2008, very few people knew outside of the accounting profession and outside of bankers that banks were not measuring losses correctly. In fact, in 2008, the people who designed the accounting standards, the International Accounting Standards Board, gave evidence, or not evidence, but they wrote in a letter, in a prepared speech and a letter, that under their rules, banks are not allowed to hide losses. So they wouldn't have been able to say that if the world had known that banks were insolvent.
Okay, and I just want to ask you finally, how far away do you think we are from another banking collapse?
If I can answer that question by finishing off a little bit of Cormac's as well, because the key issue about who knew what when, where I think things go wrong, was Northern Rock was obviously the first run on a bank in the UK for 100 years, and that was the early autumn of 2007. The day after the run on the Rock, somebody in the Times wrote an article saying, oh, what if this is the same as the City of Glasgow Bank that collapsed 100 years ago, and this isn't a liquidity crisis, this is actually a capital crisis, and that's why nobody will lend to it. It's like the markets smell that there's a problem. That analysis kind of faded away. Rolled back 6 years, and the Bank of England minutes are released publicly, and in that autumn, when the bank knows that it's lending money to the Northern Rock and the public don't know, because it was private, one board member says, have we got the right numbers? Is this actually an insolvent bank or is it a liquidity problem? And again, that analysis gets pushed away because other parties are saying, no, the banks are all solvent. But again, if you've audited a bank, I think you've got an interest in saying that the bank had capital, because and if you've audited 10 banks globally, you've got a major problem if you suddenly start to admit that there was a systemic problem. And the banking crisis was actually a capital crisis. So it suited an awful lot of people to call the banking crisis a liquidity crisis when it was actually a capital crisis. And every banking crisis in history is effectively a solvency crisis. The assets are overstated and the capital's therefore overstated. So for years people were running with a red herring. And what was quite remarkable in the UK, the Walker Review, which was done in early 2009, came up with the liquidity crisis diagnosis. When you talk to people in the capital markets, they knew that it was because they suspected that the banks were bust. I worked with somebody who was experienced enough to remember the secondary banking crisis of the 1970s, and he suspected it was a capital crisis in the first part of 2007. So there's a disconnect between what I call PR-based analysis and what I call proper fundamental common sense-based analysis. And one interesting feature of all these sort of studies and reviews during the banking crisis, the best people asking the questions and coming up with the right answers are elected politicians like yourselves asking good questions, and the press.
But surely governments are there to protect citizens. And, you know, it's all right, we're talking about all of this like it had happened, but the impact on Irish citizens and the continuing impact, you know, in terms of vulture funds and the way the banks have behaved towards citizens, they have been given a free hand by government.
Well, that's correct.
To do
and
just what they want.
Yeah, I mean, Tim brought this to light in 2010, and we're here in 2019. And it's only now that the accounting profession have admitted that they gave incorrect advice on the delayed recognition of losses. That's quite a considerable period of time. We've had a few inquiries since, both in the UK and Ireland, but there's no appetite amongst a certain group of people to bring this to light. So therefore it's very important that we don't have another lost decade, and we do bring this to light. What's happening at the moment, which I think you should be aware of, is banks are claiming that they're making profits when they sell loans to vulture funds. So if you have a portfolio of loans worth 1 million, banks claim that when they sell those loans to vulture funds, they're making a profit. They're not. They're using the same accounting techniques that they used 9 years ago. And that what they're doing is they're writing the loans down to a level that the vulture funds are willing to pay, and then they sell them to the vulture funds. This matter came to light in an article by the Financial Times on the 4th of November last year, where one bank claimed it was making a profit. But when you look through the figures and you see that a number of losses were being transferred directly against reserves, it was reasonable to conclude that that bank was potentially making a loss on the sale of the loans.
So why are they selling them if they're not making a profit?
It's a good question, because there's no concrete answer. We know that some people allege that they're put under ECB pressure to sell the loans, and there is the view that vulture funds will act more efficiently than commercial banks, but there's no evidence to support that. We do know that the ECB is saying to banks, if you sell loans to vulture funds, you can delay the recognition of losses on those loans as far as we're concerned. In other words, you can bury the losses into reserves. So you can actually, in some cases, record an accounting profit even though you've made a loss. Now, if you're worried about the sale of the assets to vulture funds, this is a potential defence that you can use. Because if a bank is selling an asset, if it's a state-owned bank and it's selling an asset to a vulture fund, and that bank is giving a subsidy, then you, the government, as government officials, are entitled to know that subsidy, and therefore you can make an informed decision as to whether this vulture fund route is the correct route or not.
And could they not do the same thing if they sold the loan to, or gave a write-down to the person who had the loan in the first instance? Like vulture funds, and I know from individual cases, are making enormous profits.
They are making enormous profits.
From the write-downs that they're being given.
If they're making enormous profits, those profits should be going to Irish banks so that those profits can be used to write down the customer loans. But what is happening is that they're selling them to vulture funds. Vulture funds are making a huge profit on it, and they're getting them at a huge discount. A few years ago, you may have remembered Project Eagle, a scandal which Mick Wallace uncovered. Basically, the Controller and Auditor General calculated, I think, a subsidy of about 300 million, which was not disclosed by the National Asset Management Agency. But what the National Asset Management Agency did was wrote down the loans to what the vulture funds were willing to pay. And because the vulture funds wouldn't want to make a profit, the loans were written down unnecessarily. Now, what should have happened is that the NAMA should have had a much more open competition to see the best price it could obtain. But they actually had a very restricted competition, and the Controller and Auditor General was of the view that the price received for the NAMA sale was substantially lower. Now, if that scandal had been acted upon, I think many of the vulture funds sales would be questioned. It's hard to believe that vulture funds are the only competent people to recover money. The Irish banks are quite capable of doing it, but because of a flawed incentive, they are selling the assets to the vulture funds. They claim that the ECB are putting them under pressure, but if you think about it, the ECB are not allowed to force banks to do that, because if you sell an asset at undervalue, there's a company law issue. You're effectively paying a dividend. and because of that company law issue, a lot of disclosure is required on the true substance of the transaction and not just the artificial accounting. In a similar way, you have instances where banks set up a special company. It might be the GRG or something like that. And what the banks do is they close down a loan. They force you to sell an asset. But this asset is dealt with through a separate company which the bank owns, and that company can make a profit because it can buy an asset at a distressed price. I have seen evidence where an individual with a property portfolio of 65 million had their assets sequestrated effectively to settle a loan worth 10 million. And I have fairly strong evidence that those assets were sold at distressed prices at relatively high discounts. What's happening in the case of the bank is they may not necessarily be recognising the loss on the loan sale, but they're recognising the profit on the distressed sale of the asset. So they're using very flawed incentive schemes around these transactions, and that has to come to light because you had bankers in front of you and you correctly asked them, what discount are you giving to the vulture funds or what discounts are you giving to other people? And they said there's a confidentiality clause there, we're not going to tell you. It's extremely difficult to see how they can justify that legally. Because if you are the owners of the asset, you're entitled to know whether the asset's been sold at a profit or at a subsidy. And if it's been sold at a subsidy, then you're into all sorts of complications breaking the law because you're not allowed to give a subsidy to vulture funds.
Sorry, you're entitled to know if you're the owner of the asset. So
you're entitled to know if the bank is better off keeping the asset and earning money or selling the asset.
Who is entitled to know, the owner
well,
of the asset?
Well, basically, if you have control over a state-controlled bank, if you own 70% of the shares, let's take Allied Irish Bank as an example. If Allied Irish Bank are selling an asset to a vulture fund, you might say to yourself, well, this vulture fund is going to make a huge profit on this. So how much extra money would we make if we retain the assets in our own portfolio so that you can see that the bank is making an informed decision? But if the bank is using flawed accounting, you cannot see what's going on, and therefore the bank could sell the asset to a vulture fund, and there could be a huge discount on that asset, and an unnecessary discount. You're entitled to know that. You must know it to make sure that you, the owner of the bank, is making, or rather the directors are making an informed decision on your behalf.
Surely that's what we have a Minister for Finance and a Department of Finance for.
Well, we brought this to the Minister for Finance's attention, and he referred us to the IAASA, which is the Institute of an accounting body. The problem with the IAASA and the corporate enforcers, the ODCE, is that they're of the view that you can delay the recognition of losses under the accounting standards, or that you can delay the recognition of losses under the law, and that interpretation is incorrect. So if you said to the ODCE or the IAASA, we've got a problem here, we first of all want to clarify whether you think it's legal to delay the recognition of losses. If they say yes, they're going to have a problem because of the AssetCo case. And if they say no, then they have to investigate instances where assets are sold to vulture funds.